January 30th, 2026. A Chicago bank goes dark. Metropolitan Capital Bank and Trust, $261 million in assets, placed in receivership by the Illinois Department of Financial and Professional Regulation. The FDIC steps in, brokers the sale to Detroit-based First Independence Bank. Cost to the insurance fund, $19.7 million. First bank failure of the year, not the last. But here's what nobody's telling you about this collapse. It didn't happen in isolation. It happened on the exact same day that gold and silver experienced the most violent single-day crash in over 4 decades. The timing isn't coincidence. The bank collapse and the metals crash are symptoms of the same disease, a financial system that has been held together by extend and pretend policies, by regulatory forbearance, by the willingness of central banks to paper over structural problems with unlimited liquidity. And on January 30th, 2026, that system showed its first visible crack. Metropolitan Capital isn't a household name. It's a community bank. Small, regional, the kind of institution that flies under the radar until the day regulators show up with padlocks. But the reasons for its failure tell you everything you need to know about what's coming next. Unsafe and unsound conditions. Impaired capital position. Those are the words used by state regulators. Translation? The bank was insolvent. Its assets were worth less than its liabilities. And when you dig into what those assets were, you find the same poison that's sitting on balance sheets across America's banking system. Commercial real estate. Metropolitan Capital reported $43 million in liabilities against advances from the Federal Home Loan Bank system in the third quarter of 2025. That's banker speak for emergency borrowing. When a bank goes to the Federal Home Loan Bank for advances, it means they're scrambling for liquidity. They can't fund operations through normal channels. Deposits are leaving. Assets are underwater. They're borrowing from the lender of last resort just to keep the lights on. And even that wasn't enough. Now, let's connect the dots. Why did Metropolitan fail on January 30th? Not January 15th, not February 10th. January 30th, because on January 29th, gold hit 5,495 per ounce. Silver touched 121.78, all-time record highs. Precious metals had been screaming higher for weeks on geopolitical chaos, dollar weakness, and a flood of capital fleeing into hard assets. And then, on January 30th, everything reversed, violently. The trigger was Kevin Warsh, President Trump's nomination for Federal Reserve Chairman. The announcement came early Friday morning in Asia, and markets interpreted Warsh as hawkish, more disciplined on inflation, less likely to flood the system with liquidity, more willing to let weak institutions fail. The dollar spiked, treasury yields moved higher, and suddenly, every leveraged position in precious metals became a death trap. Silver futures fell 31.35% by the close. COMEX February silver settled at 78.29, the largest single-day decline since March 27, 1980. That's the Hunt brothers' collapse. And Metropolitan Capital Bank, sitting in Chicago with a balance sheet full of underwater commercial real estate loans and borrowing from the Federal Home Loan Bank just to survive, couldn't withstand the shock. When the metals crashed, the collateral values backing loans across the banking system repriced instantaneously. Properties that were financed assuming stable or rising asset prices suddenly looked different when the entire commodity complex was in free fall. Risk models lit up, capital buffers evaporated, and regulators, seeing the writing on the wall, pulled the plug. Metropolitan isn't unique, it's a canary. Because the problems that killed this $261 million bank exist at scale across the entire regional banking sector. Let me show you the numbers that should terrify you. According to Florida Atlantic University's latest screening of U.S. banks' exposure to commercial real estate risk, 1,788 banks have total CRE exposures greater than 300% of their total equity capital. That's up from 1,797 in the third quarter of 2025. The number is growing. 1,077 banks have exposures greater than 400%. 504 banks have exposures greater than 500%. And 216 banks have exposures greater than 600% of their capital base. Think about what that means. If you have CRE exposure at 300% of capital and just 33% of those loans go bad, you're wiped out. Your capital's gone. You're insolvent. And academic research from USC, Columbia, Stanford, and Northwestern estimates that 33% of all commercial real estate loans in the United States are likely to become problematic or non-performing. That's not a forecast. That's based on current valuations, cash flow analysis, and refinancing challenges. The same research shows that 14% of all CRE loans and 44% of office-related loans are already in negative equity. The properties are worth less than the outstanding loan balances. Banks are pretending these loans are performing. They're extending maturities. They're modifying terms. They're doing everything except admitting the losses. This is the extend and pretend strategy that the New York Fed itself has acknowledged. U.S. banks are extending their impaired CRE mortgages to avoid writing off their capital, leading to credit misallocation and a buildup of financial fragility. Here's the problem with extend and pretend. It works until it doesn't. And on January 30th, 2026, Metropolitan Capital proved that the strategy has limits. You can extend a bad loan, you can pretend it's performing, but you can't print capital. And when a shock hits the system, when collateral values reprice, when depositors lose confidence, the game ends. Now, add the debt maturity wall. Over $936 billion in commercial real estate mortgages mature in 2026. That is debt that was originated when interest rates were 3%, loans that are coming due and need to be refinanced at 7 or 8%. A building that generated just enough rental income to cover debt service at 3% goes bankrupt at 7%. The math doesn't work. Cash flows don't cover payments. Owners walk away. Banks take the loss. And here's where the metals crash makes everything worse, because when gold and silver were rallying, there was a narrative that inflation was permanent, that hard assets would hold value, that real estate, even struggling office buildings, would eventually find a floor because the dollar was dying. That narrative kept zombie loans alive. It gave banks and borrowers hope that they could extend until asset prices recovered. But when gold falls 12% in a day and silver drops 36%, that narrative dies. The message from the market is clear. The Fed isn't going to bail you out with infinite money printing. Rates are staying higher. The dollar is stabilizing. And that means all the underwater loans you've been extending, all the bad commercial real estate you've been pretending is fine, has to be marked to reality, and reality is brutal. Metropolitan Capital was the first domino. The question is, how many more are lined up behind it? Let's look at the pattern. This isn't the first time we've seen a banking crisis triggered by a commodities crash. In 1980, silver hit 49.45 per ounce in January. The Hunt brothers squeeze, then the comics changed the rules overnight. Liquidation-only trading. Silver crashed to 10 within months. And banks that had lent against silver collateral, banks that had exposure to commodities traders, they failed. Over 200 banks failed in the early 1980s, not all at once, but steadily. A slow-motion collapse as the leverage unwound and the bad loans were recognized. In 2008, oil hit $147 a barrel in July. Commodities were screaming higher, then they crashed. Oil fell to 33 by the end of the year. And the banks that had lent to energy companies, that had financed drilling based on 100 oil, they took massive losses. The commodity crash exposed the leverage in the system. And once the leverage started unwinding, it cascaded into residential mortgages, into credit default swaps, into the entire shadow banking system. Lehman Brothers failed in September 2008. Washington Mutual in September. Wachovia in September. It took 3 months from the oil peak to the collapse of major institutions. We're in January 2026. The metals peaked on January 29th. The first bank failed on January 30th. If history is any guide, we have months, not years, before this accelerates. Now, let's talk about what the metals crash actually means for the banking system. Because this isn't just about collateral values. This is about psychology. Markets run on confidence. And confidence in the U.S. banking system has been fragile since Silicon Valley Bank collapsed in March 2023. That was the warning shot. A bank with $212 billion in assets failed in 36 hours because depositors lost confidence and ran. Signature Bank failed the same week. First Republic failed 2 months later. The system was stabilized through emergency lending from the Federal Reserve and FDIC guarantees, but the cracks never healed. And now, with the metals crash, those cracks are widening. Because the metals rally from late 2025 through January 2026 was driven by a flight to safety. Investors were fleeing the banking system. They were buying gold and silver as protection against bank failures, against inflation, against currency collapse. When that rally reversed in a single day, it wasn't because confidence was restored. It was because leverage positions were liquidated, margin calls, forced selling, algorithmic trading amplified the move, and the people who had bought metals as insurance watched their protection evaporate in hours. The psychological impact is devastating. If you can't trust gold and silver to hold value during a crisis, what can you trust? The answer for most people is nothing, and that's when bank runs start. Not immediately, but gradually. As depositors realize that the institutions holding their money are sitting on the same commercial real estate time bombs that killed Metropolitan Capital. As they see the extend and pretend strategy failing. As they understand that FDIC insurance only covers $250,000 per depositor. And the insurance fund has $128 billion to cover $10.5 trillion in insured deposits. That's a coverage ratio of 1.2%. If even a small fraction of banks fail, the fund is exhausted. Let's examine the second order effects. The metals crash destroyed wealth. Over $3 trillion in market value erased from gold. Silver ETFs like iShares, Silver Trust fell over 30%, the worst single-day performance on record. Mining stocks collapsed. Newmont, Barrick Gold, Agnico Eagle mines all fell over 10% in a single session. The wealth destruction extends beyond the metals themselves. It hits portfolios. It hits pensions. It hits endowments that had allocated to commodities as inflation protection. And when wealth gets destroyed, consumption falls. People who felt rich at 5,500 gold feel poor at 4,700 gold. They cut spending. They delay purchases. They reduce risk. This feeds into the real economy. Businesses lose revenue. They lay off workers. Unemployment rises. And unemployed workers stop paying their mortgages, their car loans, their credit cards. This creates a feedback loop into the banking system. Consumer loan defaults rise at the exact moment that commercial real estate loans are going bad. Now, add the geopolitical dimension. The metals rally was partly driven by U.S. military operations in Venezuela. On January 29th, reports confirmed that the U.S. had launched strategic operations to remove Nicolás Maduro. Markets interpreted this as a resource grab. Oil, minerals, strategic metals. When the most powerful military on Earth mobilizes to secure resources, it sends a signal to every other country. Secure your resources or lose them. This triggered safe haven buying in gold and silver, but when the metals crashed the next day, the geopolitical narrative didn't change. The military operations didn't stop. What changed was the financial system's ability to price that risk. When margin calls force liquidation, fundamentals don't matter. Price is determined by who needs to sell, not by what the asset is worth. And the forced selling overwhelmed the geopolitical bid. This creates a dangerous disconnect. The reasons to own gold and silver, systemic risk, currency debasement, geopolitical chaos, they're all still present. But the price action says the opposite. This is how market structure breaks. When the signal and the reality diverge, participants lose confidence in the price discovery mechanism itself. And that brings us to the real systemic warning. The metals crash exposed how fragile liquidity is in supposedly deep liquid markets. Gold is a 15 trillion asset class. It's supposed to be the most liquid commodity in the world. But on January 30th, bid-ask spreads blew out. Trading volume collapsed. Market makers stepped back. Why? Because banks don't have infinite balance sheets to trade precious metals. When volatility spikes and risk explodes, liquidity disappears. And when liquidity disappears, prices gap violently. Simon Biddle, head of precious metals at Tullett Prebon, said it clearly. Trading volumes have decreased as banks are taking less risk. Banks are pulling back from market making in commodities because their capital is constrained. They need that capital to absorb losses in commercial real estate. They need it to meet regulatory requirements. They don't have the capacity to provide liquidity in metals during a crisis. And if they can't provide liquidity in gold, the safest safe haven asset, what happens when there's a run on a bank? What happens when there's a liquidity crisis in credit markets? The answer is no bid. Market failure. This is the systemic warning embedded in the Metropolitan capital collapse and the metals crash. The financial system is more fragile than it appears. Extend and pretend works in calm conditions. But when volatility hits, when forced liquidations start, when market makers step back, the system seizes. And the seizure spreads from the weakest institutions, small regional banks like Metropolitan, to larger players. Let's look at the banks that are most exposed. Metropolitan Capital was $261 million in assets. It barely registers. But the pattern that killed it exists at much larger institutions. Banks with assets between $1 billion and $10 billion have the highest concentration of commercial real estate exposure. These are regional and community banks. They don't have diversified national portfolios. They're concentrated in local markets, office buildings in downtown Chicago, retail space in suburban malls, hotels that were financed assuming business travel would return to pre-pandemic levels. It hasn't. Office vacancy rates in major cities are 40 to 50%. The demand for office space has fundamentally shifted downward. Remote work isn't a temporary pandemic response. It's a structural change. Companies that used to lease 5 floors now lease 2. Buildings bought in 2019 to 2021 at peak prices with 3% mortgages are now worth 40% less. Those mortgages are maturing. Owners need to refinance at 7 to 8%. They can't. The cash flow doesn't cover the payments. They default. Banks take the loss. And the losses are piling up. The delinquency rate for loans on Manhattan office buildings jumped more than 1,000% from January 2023 to January 2024. FDIC data shows the non-current rate for non-owner-occupied commercial real estate loans hit 1.59%, the highest level since the fourth quarter of 2013. That's rising, not falling. And it's rising before the full weight of the debt maturity wall hits. Pulaski Savings Bank in Chicago failed in January 2025. It cost the FDIC $28.5 million, roughly 58% of the bank's assets. That's an extraordinarily high loss rate. It tells you the assets were worth almost nothing. The bank had to be closed because there was no way to make the numbers work. Metropolitan Capital's failure cost $19.7 million on $261 million in assets. That's a 7.5% loss rate, much lower than Pulaski. But the fact that Chicago has now had 2 bank failures in 2 years, both linked to commercial real estate, tells you the stress is concentrated geographically. And if it's happening in Chicago, it's happening in other cities with similar exposure. 71 Illinois banks have failed since 2000, including 22 in Chicago. Illinois has a terrible track record, but the problem isn't confined to one state. Over 900 banks nationwide still carry commercial real estate exposure above 300% of capital. The stress is systemic. It's not one bad bank. It's hundreds of bad banks, all playing the same extend and pretend game, all hoping that values recover before the loans mature. And the metals crash just killed that hope. Now, let's talk about the Federal Reserve's role in this. The Fed has been the backstop for the banking system since 2008. Every time there's been stress, the Fed steps in. Quantitative easing, emergency lending facilities, bank term funding program. The message to markets has been clear. We won't let the system fail. But Kevin Warsh's nomination changes that calculation. Warsh was a Federal Reserve governor during the 2008 crisis. He's known as a hawk, someone who believes in discipline, someone who thinks moral hazard, the idea that banks will take excessive risk if they know they'll be bailed out, is a real problem. If Warsh becomes Fed chair, the expectation is that he will be less willing to flood the system with liquidity every time something breaks. He'll let weak institutions fail. He'll prioritize price stability over financial stability. That's why the markets reacted so violently to his nomination. It's not that Warsh is anti-bank. It's that he's pro-discipline. And discipline means pain. It means recognizing losses. It means allowing zombie banks that have been kept alive by cheap money and regulatory forbearance to actually fail. Metropolitan Capital is the first. But if Warsh signals that the Fed won't backstop every regional bank with commercial real estate problems, the market will start pricing in a wave of failures. Depositors will move money to larger, safer institutions. Credit will tighten, lending will contract, and the economy will slow because banks are the transmission mechanism for monetary policy. When banks are in trouble, they stop lending, and when they stop lending, growth stops. The metals crash is a preview of what happens when the market believes the Fed's put is gone. The Fed put is the idea that the Federal Reserve will step in to support markets when they fall. Investors have relied on this for 15 years. Buy the dip. The Fed will save you. But if Warsh takes over and signals that the Fed won't intervene, that put disappears. And without the put, risk assets fall until they reach valuations that can stand on their own without the assumption of central bank support. We haven't seen those valuations in over a decade. Let's examine the international dimension. The metals crash wasn't confined to the United States. London silver fell below 74.60, a 35.5% intraday decline, the largest on record. Copper fell 3.4% in London after hitting an all-time high. Base metals, industrial metals, precious metals, everything sold off simultaneously. This is risk-off behavior. When everything correlates to one, when diversification fails, it means systemic stress. Central banks around the world have been buying gold at a rapid pace. In 2022 and 2023, central banks purchased over 2,000 tons of gold, the most since 1950. They were diversifying away from the dollar. They were reducing exposure to U.S. Treasury securities. They were buying hard assets as insurance against currency debasement and geopolitical fragmentation. And then, in one day, that trade got annihilated. Gold fell 12%. Central banks that bought at 5,500 are now sitting on unrealized losses of over 800 per ounce. This creates a policy problem. Central banks don't like losses. When an asset they've been accumulating crashes, it raises questions about the strategy. Do they buy more at lower prices? Do they hold and wait for recovery? Do they sell and take the loss? The decision they make will determine whether the gold market stabilizes or continues falling. And if central banks start selling, if they decide gold at 4,700 is still overvalued, the floor drops out. We could see gold at 4,000 or lower. And at that point, the narrative that gold is a safe haven is permanently damaged. The same dynamic applies to silver. Silver's crash was even more violent than gold's. A 36% intraday decline is unprecedented in modern markets. And silver isn't just a monetary metal, it's an industrial metal. It's used in solar panels, electric vehicles, semiconductors, medical devices. The demand from these sectors is real, it's structural. But on January 30th, none of that mattered. Industrial demand doesn't stop a margin call cascade. Here's where the silver crash tells you something important about the economy. And if the market is right, if the economy is heading into recession, the commercial real estate crisis gets exponentially worse because recessions kill businesses. And when businesses fail, they vacate office space, they close retail stores, they cancel hotel bookings, vacancy rates spike, rental income falls, and the marginal buildings, The ones that were barely cash flow positive in a good economy go bust in a recession. Metropolitan Capital failed in a growing economy. Unemployment is around 4%. GDP growth is positive. The stock market was hitting all-time highs until recently. If a bank fails under these conditions, what happens when the economy contracts? The answer is obvious. More failures. Many more. Now, let's talk about what you're not being told. The official narrative around Metropolitan Capital is that it's an isolated event, a small bank with idiosyncratic problems, poor management, bad loans, nothing systemic. The FDIC and state regulators will say they acted quickly to protect depositors. No one lost money, the system worked. But that's the same narrative they used before Silicon Valley Bank collapsed, before Signature Bank failed, before First Republic imploded. Every time, the message is the same. Isolated event. No contagion risk. System is strong. And every time, the next failure happens a few weeks later. The metals crash adds a dimension that wasn't present in the 2023 bank failures. This isn't just about deposit flight or interest rate risk. This is about collateral values across the entire financial system repricing in real time. When gold and silver crashed 12% and 36% in a day, every loan that was collateralized by metals, every trading position that was hedged with metals, every balance sheet that counted metals as Tier 1 assets, all of it gets marked down instantly. And the margin calls go out, and the forced selling begins, and the liquidity disappears. This is how systemic risk propagates. It doesn't start with the biggest institutions, it starts at the edges. Small banks, over-leveraged hedge funds, commodity traders. And then it spreads, because the financial system is interconnected. When one player fails to meet a margin call, their counterparty takes a loss. That counterparty then has to sell assets to cover the loss. That selling pushes prices lower, which triggers more margin calls, which forces more selling. The feedback loop accelerates until someone steps in to break it. Typically, that someone is the Federal Reserve. But if Warsh is signaling that the Fed won't intervene, the loop runs until it exhausts itself. And that means much lower asset prices and many more failures. Let's look at the timeline. January 30th, 2026. One bank fails, metals crash. February 2026. We're here now. The question is, what happens next? Based on historical patterns, there are three possible outcomes. Outcome one, this was the bottom. The metals crash was a washout. Weak hands were shaken out, leveraged positions were liquidated, and now with gold at 4,700 and silver at 78, the fundamental buyers step in. Central banks, industrial users, long-term investors, they buy the dip, prices stabilize. The commercial real estate crisis continues to unfold slowly through extend and pretend. A few more small banks fail over the next year, but there's no cascading collapse. The system muddles through. This is the optimistic scenario. Probability 20%. Outcome 2. This is the beginning of a slow unwind. More banks fail over the next 6 to 12 months. Not in a concentrated panic like 2008, but steadily. 1 or 2 per quarter. Each failure chips away at confidence. Depositors move money from smaller banks to larger ones. Credit conditions tighten. Lending slows. The economy weakens. Metals remain volatile but don't collapse further. The Fed provides some liquidity support but not unlimited. We get a managed decline rather than a catastrophic collapse. This is the muddling through scenario. Probability 50%. Outcome 3. This is 1980 or 2008 all over again. The metals crash is the signal that leverage in the system has reached unsustainable levels. More banks fail in February and March. A larger regional bank, something in the 10 billion to 50 billion asset range, goes down. Panic spreads. Deposit flight accelerates. The Fed is forced to intervene with emergency facilities, but confidence is broken. The economy enters recession. Commercial real estate losses explode. Hundreds of banks fail over the next 2 years. This is the catastrophic scenario. Probability 30%. None of these scenarios are good. The best case is that we avoid catastrophe. But even in the best case, the banking system takes years to heal. Commercial real estate losses have to be recognized. Capital has to be rebuilt. And during that time, credit is constrained, economic growth is slower, and the wealth destruction from the metals crash, over $3 trillion in a single day, creates a negative wealth effect that suppresses consumption for years. Now, let's connect this back to you. Why does this matter if you don't own a bank or trade metals? Because you live in an economy that runs on credit, and credit runs through banks. When banks are under stress, they pull back lending. Small businesses can't get loans to expand, home buyers can't get mortgages, auto loans get harder to obtain, credit card limits get cut, the availability of credit shrinks. And when credit shrinks, economic activity slows. You see it first in the things that don't happen. The business that doesn't open, the house that doesn't sell, the car that doesn't get financed. These aren't dramatic events, they're quiet. But cumulatively, they add up. The economy stops growing. Unemployment starts rising, not to 10% immediately, but from 4% to 5%, then to 6%. each percentage point increase is millions of people losing their jobs. And those people stop spending, which causes more businesses to fail, which causes more people to lose jobs. The spiral feeds itself. And if you have money in a bank, particularly a smaller regional bank, you need to understand the risks. FDIC insurance covers $250,000 per depositor per institution. If you have more than that in a single bank, the excess is uninsured. If the bank fails, you could lose it. This isn't theoretical, it's happened. In 2023, depositors at Silicon Valley Bank with balances above $250,000 were frozen out for days until the government stepped in with emergency guarantees. And that guarantee isn't automatic for every bank. Metropolitan Capital's depositors are covered because First Independence bought the deposits. But if a bank fails and no buyer steps up, uninsured depositors take losses. The lesson is simple. Diversify your deposits. Don't keep all your money in one institution. Spread it across multiple banks, all under the $250,000 FDIC limit. It's not exciting. But it's insurance. And in an environment where banks are failing and metals are crashing 36% in a day, insurance is what separates survival from catastrophe. Let's talk about the metals themselves. Gold and silver crashed. Does that mean they're no longer safe havens? Not necessarily. The crash was driven by leverage and forced liquidation, not by fundamentals. The reasons to own gold, protection against currency debasement, insurance against systemic risk, those haven't changed. What changed is that a lot of people who bought gold and silver were using borrowed money, margin, leverage. And when prices fell, their brokers forced them to sell. This is a structural problem with futures markets and leveraged ETFs, not with physical gold and silver. If you own physical gold and silver, metal you hold in your possession or in allocated storage, you weren't affected by margin calls. Your metal didn't disappear. It just declined in dollar value. And if you believe the dollar is headed for debasement, if you think central banks will eventually return to printing money, then the decline is temporary. A shakeout. An opportunity to buy more at lower prices. But if you were trading futures or leveraged ETFs, you got destroyed. The leverage that amplified your gains on the way up amplified your losses on the way down. And many people got wiped out. This is the danger of treating metals like a trading vehicle instead of insurance. Insurance, it doesn't make you rich. It protects you when things go wrong. And the things that could go wrong, banking system collapse, currency crisis, geopolitical chaos, they're all still possible. The metals crash doesn't eliminate those risks. It just reminds you that even insurance has volatility. And if you can't stomach the volatility, you shouldn't own it. But here's the critical point. The metals crash, and the bank failure happened on the same day. That's not random. It's a signal that the financial system is under stress. When safe haven assets crash and banks fail simultaneously, it means the system is struggling to price risk. Markets are dislocated, confidence is fragile, and the margin for error is gone. Metropolitan Capital Banking is the first failure of 2026. The metals crash is the first systemic shock of 2026. We're 30 days into the year. If this is what January looks like, what does the rest of the year hold? Based on patterns from previous crises, the answer is more volatility, more failures, and more forced recognition of losses that have been hidden by extend and pretend. The 2008 crisis didn't start with Lehman Brothers. It started with small cracks, Bear Stearns, IndyMac. The cracks widened. More banks failed. Confidence eroded. And then in September, the dam broke. Lehman failed. AIG needed a bailout. Money market funds broke the buck. The entire system froze. The Fed had to create trillions in emergency liquidity to prevent total collapse. Could that happen again? Yes. The ingredients are present. Excessive leverage, underwater assets, fragile confidence, and a Federal Reserve that might be less willing to intervene under new leadership. The difference between 2008 and 2026 is that in 2008, the problem was residential mortgages, subprime loans. In 2026, the problem is commercial real estate, office buildings. But the mechanism is the same. Bad loans, over-leveraged banks, extend and pretend, until the day the pretending stops. And on January 30th, 2026, for Metropolitan Capital Bank, the pretending stopped. The systemic warning is clear. The banking system is more fragile than the headlines suggest. The metals crash expose leverage and liquidity problems that extend far beyond commodities. And the first failure of the year happened not in isolation, but in the context of the largest single-day precious metals collapse in over 4 decades. This isn't normal. This is a stress signal. And stress signals, when ignored, turn into crises. The question isn't whether more banks will fail. The question is how many, how fast, and whether the system can contain the failures without a broader collapse. History suggests containment is difficult once confidence breaks. And confidence breaks when people realize that the institutions they trusted are insolvent. Metropolitan Capital was insolvent. The regulators knew it. The depositors didn't until the day the doors closed. How many other banks fit that description right now? How many are insolvent on a mark-to-market basis, but still operating because regulators allow them to carry assets at inflated values? The answer is many, potentially hundreds. And the metals crash just made the problem visible to anyone paying attention, because when gold falls 12% and silver falls 36%, it reprices risk across the entire financial system. And that repricing reveals what extend and pretend was designed to hide. The losses are real, the assets are underwater, and the capital isn't there. This is the first bank collapse of 2026. The metals crash is the first systemic warning of 2026. What you do with this information determines whether you are positioned for what comes next or caught in the collapse when it accelerates. The pattern is clear, the timeline is compressing, and the margin for error is gone. Don't forget to like the video, comment your thoughts down there, and subscribe.